everyone, and welcome to Connected by Community, our podcast brought to you by Ballantyne Capital Advisors. I'm Brian Ballantyne, and I'm here with Anthony Colancheco and Eric Stein today. Eric Stein joins us from East Bay Investment Solutions. Eric, welcome. Glad to have you here today.
Thanks, Brian. Glad to be here.
And so we're here to talk about fun, stimulating stuff investments. So,
All right.
Connected by Community is really, I guess I should say, it's really about who we are, where we are, and what we are as a community. And frankly, investments are part of who we are. Whether someone's invested in the market, they're affected by it. And certainly, probably if they aren't, they should be.
Mm-hmm.
So we want to talk about that because we think it matters to people and who they are and what they're doing. But before we jump into all that fun stuff, tell us a little bit about yourself. Who, kind of your background, personally, family, that kind of stuff. I'd like to know a little more about you.
Sure. I'd say personally, I've married. I'm actually about to celebrate my 20th wedding anniversary with my wife later this year. So big milestone for us. And then I've got two teenage boys, Scott and Jack. Scott is going to be a rising senior in high school, and Jack is going to be a rising sophomore. So two kids in high school. Both are, one's driving, one's starting to drive. So lots of stuff going on in our household from the kids' perspective and all the things that go along with school and just having two teenage boys. So all good there. And then from a professional side, I'm a partner with East Bay Investment Solutions. We are what's called an OCIO provider. It stands for Outsourced Chief Investment Officer. And we work with advisors like Ballantyne Capital really to help with investment strategy and consulting and things like that. I've been doing that for a couple of years as part of East Bay. But prior to that, I had a long career with a national accounting firm and wealth management unit where I was their chief investment officer. And prior to that, for a little more than 7 years, I worked with Goldman Sachs Asset Management in New York, doing just a variety of different things throughout my tenure there. So I've had a pretty varied career, working with institutions, working with high net worth individuals, working with advisors. It's been pretty interesting to see how markets have changed, how the business has changed, how clients have changed. It's been pretty interesting to have the experience that I've had throughout all these years.
Man, that's a lot to unpack. So I'm going to go back to the beginning because I'm stuck on you got two teenage boys because I got a boy and a daughter, a rising junior and a rising sophomore. So I forget that when I know that about you, but we've got to just compare notes.
Yes.
You could go to certain schools. I could go to certain ones, and we could save ourselves some time maybe.
We've got college visits coming up,
well,
right?
You're ahead of me. That's what I'm wondering.
Okay.
You both could write a book, and then I could read it.
Yeah, there are many books. They're all, what's been interesting, too, and I'm sure you've seen this with your son, COVID has just changed everything. We were planning on going on college visits last year, and schools were closed, tours were closed. There was really nothing to see. So, all these schools have been great at doing videos, but there's something about, as being on campus where you can get the feel for the students and what's going on that you just don't get from reading a book or watching a video. So we're hopeful that this year things are.
Are they going to open them back up then?
It seems like they are. Most schools that we've talked to seem like they're starting to open back up in the summer or the fall. So we'll have an opportunity before he has to decide where to go, what's going on there. But it's been an interesting year for everybody for obvious reasons. But just from the school selection standpoint, the kids that are going this year really didn't have an opportunity to really visit much before they went.
Interesting. So we're a year behind because mine's just a rising junior. And I guess the PSATs got published from last year or whatever. So he's starting to get all these mailings. We at least know the schools are spending a lot on marketing. Because he's getting like 3 or 4 a day that he's throwing away. And he's like, well, this school's really spending a lot of money.
Yeah, it's like they haven't caught up with the kids in technology of, why aren't they spending more on the technology behind what they're doing? My son doesn't think about looking at mail,
right.
Unless we tell him like, oh yeah, you got a letter from such and such school. He's like, okay, what am I going to do with this? He doesn't really think about it that way. So I'm sure they're online and different places, but I don't know that they're reaching all the kids in the same way that they should be.
I'm sure. Yeah, that's interesting. And I got one driving and one not too. So we're the one not, I'm not sure when, but she says sometime this summer. We'll see.
He just got his, the younger one just finished his behind the wheel portion. And then I think next week he's actually going to get his permit. So we'll have two, one officially, one unofficially, I'll say, driving Yeah, next week. So yeah, it's
That's freedom for mom and dad. That's what
Stress
I learned.
level.
Stress level.
Stress
stress
level's
level,
going
yes. Stress level goes up, but yes, freedom has been great. Not having to take them to all the different practices
Yeah.
opens up time and frees them up to have more things that they want to do. But yeah, it's definitely different than thinking back to you've got little ones. I think back to when they were that small and went on the way. It's crazy to think about. It wasn't that long ago where we were and where we are now. So
It goes by quick, doesn't it?
very quick,
Yeah, that's for sure.
very quick.
Well, let's jump to the fun stuff. Well, maybe that was the fun stuff. Let's jump to the boring stuff. So you, again, unpackaging what you said, you've had a lot of experience. I guess share with me before we get into kind of investment strategy. What did you take or learn from some of working with the big boys, if you will? Working with Goldman or maybe having some affiliation with larger firms. What did you take from those experiences that the average investor or the average person that's looking at investments might think about or want to know from someone who's been there?
Yeah, I mean, I think the simple thing is it's really hard to get it right all the time, next to impossible, really. If you think about a firm like Goldman Sachs, there's a lot of really smart people there. There's a lot of time, a lot of energy, a lot of resources being spent to outperform. And, it's really hard to do. If you look at, funds from them or frankly, funds from any fund company or any asset management company, nobody consistently outperforms all the time. It just doesn't work that way. So, when you see a firm like that putting, that much effort into it, and again, all the firms do it. They all put a lot of effort into it. It's just really, really difficult, next to impossible, really, to just consistently outperform. The statistics show it. There are reasons why. It's not that they're not smart people. They're very smart people, but markets change. There are other factors that move markets and move certain stocks. So you could have a particular style of investing that may be out of favor. There's just all sorts of reasons why a fund may underperform a certain benchmark. So it's that I'd say that was one of the big takeaways is it's just really hard. So, when we see investors that say, oh, I can just do it myself, there are parts of it they can do themselves, but the planning that you all do, that's really the big part too, that I don't think investors really take into part in terms of what kind of accounts they should have, how it impacts their taxes, what kind of holdings they should have, what their withdrawal strategy looks like. The planning that you do is just on a completely different level than even just the investment side. So, if we're spending all of our time, all of our energy, all of our resources doing this, we have education and schooling and credentials to do it, to think that people are just going to do it on the side, I just think that's a false premise that, they're just going to miss aspects that could be very important to their financial future that they're going to just frankly miss by not working with advisors.
It's interesting. So over 2 decades of working with individuals, I would say the exact same thing. You come from a little more of an institutional background, but working with retail folks, I would see that as well. And what's the interesting thing, that concept's true whether we're talking about somebody with 10 or $15 million or somebody with $15, right? And I see it in 2 different ways, and I'm curious to get your take. So the family or couple that comes in that has $10 million, relatively wealthy, sometimes thinks there's something special for them. Like, well, gee, yeah, I know you tell that to everyone, right, Eric? Right? A Goldman Sachs thing, but certainly for me, I have 10. Let's say if I had $10 million, you got a special deal, and we can do something better, right? Did you ever get the sense working at the high net worth desk or working with some of those folks, the high net worth, that they thought there was something special? And sometimes there's a vulnerability, and maybe that's how some of the Bernie Madoffs or some of these things creeped in, that they were vulnerable and didn't even know they were obviously smart people. They got very wealthy, but maybe because of that, they got arrogant, cocky, lazy, or thought there was something that was unique to them. So I'm curious if you ever saw that.
Yeah, it's interesting when you see clients of different sizes. It's at the end of the day, it seems kind of funny from my side because it's just a number. So whether a client has $1 million, $10 million, or $50 million, it's very personal to them, and it's their money. And a person with $1 million may think they're incredibly rich. A person with $5 million might think that if the market goes down 10%, they're destitute. So it's a very emotional. It has to do with their background, how they were raised, how they view money, and it's really different depending upon what their viewpoint is. So you have to take all of that into account. I'd say when you have just large sums of money, whether it's $1 million, $5 million, $10 million, it gives you access to different things. It doesn't mean you need it. It doesn't necessarily make it better. It just opens up avenues that you're able to invest in certain things. So if you think about things like private equity, for example, there are rules around who's able to access it, and there's something called a qualified purchaser, which we don't have to get into the technicals of what that is, but in general, you need about $5 million to be a qualified purchaser. Again, there's some nuances behind what that looks like. So just because you have $5 million doesn't mean that you need to be in private equity. It just means you can be in private equity. Whereas someone with $2 million, they can't be in the same way. It doesn't make them less wealthy. It doesn't make them less smart. It just means that the government, the SEC, and others have set up rules to try and protect people from certain things, and sometimes from themselves, frankly. So when you have a large sum of money, again, it just gives you access, but it doesn't make you, it doesn't force you into certain investments. And if you went to Vanguard, there are many clients that have multi-million dollars in Vanguard index funds, and they're just fine. You don't, again, have to have certain investments just because you have the access. It just means you're able to, but it doesn't necessarily make them better.
Gotcha. And I think what I have seen dealing with in retail folks that, and I guess I should clarify when I say retail folks, the individuals with the funds coming into our office or talking to them, maybe they sometimes think, well, I've got $10 million, I'll take 500,000 and I'll invest it in a cornfield in Iowa that someone, I'm just making that up. And I think Hillary Clinton made a bunch of money in corn, but I think it was in futures. But anyway, what my point is, I'm going to invest in something really obscure. I know nothing about corn, right? I made my money as a small business owner or plumber, and I'm now going to invest in corn. It sometimes allows flexibilities that I've seen make them vulnerable that they wouldn't have otherwise gotten into that. And I guess that's what I see from the behavioral standpoint of working with the individuals. I'm not qualifying those investments. I'm more talking about the behavior behind it, which is what we always preach, is the behavior behind the investments. And one of the things, kind of switching back to the other side, that I see now is what I call this entertainment that we've seen mixed in with investments a lot. Years ago, it kind of started with Jim Cramer. And when we used to do workshops and seminars, I would tell people at one time, Jim Cramer's producer was the guy who produced WWE wrestling, right? So if you don't think it's not entertainment, I mean, look where, it's about paying attention. Jim Cramer's still out there, I guess, doing his yelling and screaming mad money, but we've taken another step and now we've put technology at people's fingertips. And before we started, we were kind of chatting about how even our kids are kind of getting into this and having, which is good. Part of that's good. I'm not necessarily speaking negatively, but I think the entertainment mix with investment has the potential for gasoline and fire without training. And we have technologies like some of these apps of Robinhood and et cetera, and GameStop and Bitcoin. So I'm saying a lot here, but I guess I want to just get your take on what you see out there, and even down to the teenager, to the average investor who maybe doesn't have a lot, or they sometimes getting caught up in the hype because of the access and availability that maybe wasn't there even 10 years ago.
Yeah, it's interesting you brought up Jim Cramer, and we could even take it a step further than that and go back in time, before even cable TV, let's say. Think about newspapers and magazines. Is how do they make money? They make money through advertising, and they're only going to get advertising if they have readership. Well, how do you get readership? You don't have readership and viewership from TV if you're boring. So you need to have some excitement. You need to have something that people want to watch, people want to pay attention to. So that's why Jim Cramer, with all of his buttons and his yelling and his shouting, we're not checking to see whether the stock picks actually make sense. We're watching it because it's entertaining. And some people will follow it, and some people may do well, and some people may not. We wouldn't necessarily call that the way to financially plan and invest, but it's certainly entertainment. And now with technology the way it is, as you said, I think what's really changed is the democratization of data. People just have access to more data faster, more easily, so they can see what's happening in the markets. They can see what's happening in stocks just on their phone. They can trade on their phone. Before it was you had to go to a Charles Schwab office or your broker or an advisor, and trade a stock or call them on the phone and do that for you. Now you can just do it from the palm of your hand very, very easily. So I think the ease and access has, again, been a very good thing for some, but if you don't know what you're doing, you can get yourself in a lot of trouble. The whole meme stock thing, whether it's GameStop or whatever, has been interesting as well. Kind of as you said, it was really interesting to watch my kids with the whole GameStop saga, asking them questions about, what do you think about what's happening? Why is GameStop jumping up in price? And just understanding their response and hearing their response and saying, okay, well, here's what's actually happening. Here's why that stock is moving. And asking themselves questions like, okay, GameStop was, $5 not too long ago, and now it's trading at, $100 or whatever it was at. Why is that? Somebody has to value it at that level. So what happened to GameStop that somebody said, well, something that's worth $5 is now $150 or whatever the price may be? Has something changed with the company? Has new money been put into the company? Are they going in a different direction? What's the rationale for the valuation behind it? Because if you don't understand the valuation, it's just a number. And the concern was that there were going to be a lot of retail investors, people that were just caught up in the hype, that were buying it at 150. Well, eventually they're going to need to sell it. And the likelihood of them making money just became smaller and smaller as time went by. And that's what the concern is there's so many smart people out there in institutions and hedge funds that are watching these things regularly, that the retail investor that's just doing it on their side, on the phone, just watching the hype, they're going to get caught up, and unfortunately, they're probably going to be the ones that lose more often than not.
Yeah, it's interesting you say that last part, because I've often had this conversation with clients or prospective clients. If you think you're going to outsmart the collective wisdom of Goldman Sachs and the other bankers sitting on Wall Street, not only they have really smart people, their technology they have, they even set their offices closer to the trading floor so that the electronics go quicker. It's that big of an investment. Yes, your phone's a great democratization tool, but it probably is not a good competitive tool against some of these bigger folks.
Yeah.
And so I think that's where you have to be careful. But I like you, I think it's great to have conversations with kids in our society to say, okay, let's learn from these things. It's like most things in life, right? How you use the tool is more important than do we have a tool is a great thing. It's how we use it.
It's also the question of what are you trying to accomplish? For my teenage boys, when I'm teaching them about saving and investing, we're not trying to get rich quick through one trade or one stock or whatever the case may be. I'm trying to teach them how to invest over the long term, strategically, thinking about it very smartly for their future. So what they're going to do is very different than what somebody who's just trying to make a quick buck in a particular stock or gets caught up in the hype might be doing. So again, just trying to have those lessons and conversations with them to teach them the difference between investing and speculating. Those seem like the same at times, but if they're conflated, that's when you can get into trouble. So just being able to sit back and say, okay, here's what we're doing. Here's why we're doing it. Yes, somebody may be doing better than you performance-wise for the short term, but let's really look at the long term and what are you trying to accomplish? You're not trying to necessarily outperform your neighbor. You're basically trying to retire and have enough money to meet your goals over time. And if you can do that successfully, don't worry about what everybody else around you is doing.
Awesome.
I'll just ask a question. What's going on in the market today?
Today, I'd say the biggest topic going on today is inflation. Just people asking questions about inflation. And what's interesting is, if you look back, unless you were investing in the 70s, early 80s, we haven't really seen significant inflation since. It's sort of been creeping down since the 70s. So when we're talking about inflation today, we're talking about 3%, maybe 4% inflation. The economists I read and see aren't really talking about 70s style inflation. So part of why we're seeing inflation today is kind of where we came from last year. We had a massive global shutdown. People weren't spending a lot of money. People weren't going out. So, there was really not a lot of spending. So we were sort of at the depths of inflation levels from a low point. So if we look at year over year statistics, in March, in April, in May, you start to see, again, those year over year numbers start to creep up. So, if you look at what the Federal Reserve is saying, they're saying that the inflation we're seeing right now is transitory or temporary, that it's because of supply shocks, it's because of demand coming out of the shutdown and COVID that we're seeing that. The question is going to be, is it something we're going to continue to see? Are we going to continue to see inflation through the end of the year? Are we going to continue to see inflation through even next year? And that's really the big debate going on right now is what does it mean for inflation? What does it mean for interest rates? And how can investors sort of, guard against, let's say, unexpected inflation if it were to creep up more than what's expected right now?
So I guess maybe just for our listeners, what tends to happen when you have inflation? I mean, how does the Fed usually fight that? Or, what are some things that could be an outcome, even if we're only at, let's say we go 3, 4, 5%, right? Maybe not late 70s, early 80s style, or we creep up to 6. What are some tools or things that could be seen out there?
Yeah, so if you think about some of the tools, a lot of investors, if we think about inflation, the equities have generally been a great way to outpace inflation. Notice I didn't say it's a good hedge to inflation because it's actually not a hedge to inflation, but equity returns over time have historically outpaced inflation. So if you're an investor that is, I'll say more significantly invested in stocks or equities more than fixed income, equities, again, over time have been shown to outpace inflation. So that's a great way to do it. If you really want to hedge inflation and really unexpected inflation, there's securities called TIPS or Treasury Inflation Protected Securities. And those are, can be a great way to guard against and literally hedge inflation. That's really the only tool that completely and totally hedges inflation. So that's, that's kind of the best ways to do it. There are other securities out there or ways to think about it, but those are generally the two that we would think about most.
Gotcha. The other thing you mentioned was interest rates. What might consumers face? Would we see a potentially rising interest rate environment? I guess when interest rates are zero, they can only rise. It's a matter of when, and I'm not going to ask you when because none of us know, right? But I mean, it's reasonable to expect if we have inflation that it's possible at least that we see rising rates.
Well, actually, if we are at zero, you can actually have negative rates. So that's
I guess
that's not out of the question, and we can spend another 2 hours talking about
Sorry.
negative rates, which I wouldn't want to even go into. But yeah, so if you have higher inflation, what traditionally the Fed has done is actually increased rates. So when you increase rates, you sort of make it more expensive to spend. People dial back their spending. It's more expensive to borrow, and you sort of start to see inflation creep down. What's different now is the Fed has said that they actually want to have a target of inflation of 2%, or an average target of 2%, whereas before it was a set target. So we actually expect to see inflation kind of creep up a little bit over 2% because we haven't even been at 2% for a number of years. So we may expect to see higher interest rates. At some point, the Fed will be less accommodative as they've been right now. So we'll see, again, the short end of the yield curve, which is the Fed has set rates at zero. We'll start to see that come up. We'll start to see them taper some of their purchases first before we actually see a rise in rates. So that'll happen first. But at this point, they're really just waiting to see what happens with inflation. The guidance they've said is we don't expect to raise rates again until 2023. So we're still far off from that. Things can change, obviously, depending upon what happens later this year and early next year. But even if we have rising rates, it's not necessarily a terrible thing. If I'm a saver, right now, if I have my money in a CD, I'm not earning anything. So if I actually can earn something on my fixed income for retirees, for savers, having somewhat higher rates isn't necessarily a bad thing.
But if I'm hearing you right, the spenders, if I'm going out buying a car and I didn't save up to pay cash and I'm going to finance it, instead of getting a 2% car loan, I may have to pay 3 or 4.
Correct. Yeah. Once you start to see rates rise, the cost of lending or borrowing is going to go up. So whether it's a car loan, whether it's a mortgage rates have been, historically low for the last several years, which is part of why you're seeing this amazing, housing price rise. But you'll see the cost of borrowing go up regardless once you start to see rates rise.
Awesome.
Why should people invest now? I mean, the market's been so up. Why should I invest now?
It's a great question, Anthony. And if you think about it, if you actually just look at the market over time, We would say it's the time in the market, not trying to time the market. You know, we've seen a lot of people try and frankly fail and trying to time the market, getting in and getting out at the right time. You have to be right both times, and nobody ever is. So our view is to really just have time in the markets. And over time, the markets have just continued to go up and increase. And if you believe in that going forward, whether you're now, whether you're in a week from now, the markets should continue to go up. There will always be periods of downturns. There will always be periods of volatility. But again, over time, you should see the equities and stocks globally increase. So our feeling is, now is as good of a time of any, and we don't know what's going to happen. We don't know what's around the corner. So let's just invest now and again, be in the markets rather than trying to time them.
Awesome.
So one thing's that I've seen through the years is I'll hear people use this word risk, and I think words matter a little bit. And I think it's the wrong word. I think the word that people see is volatility. Yes, you can have some risk that maybe things don't come back, especially if you're not diversified and you've bought that corn farm that I was talking about earlier and corn goes down. But if you're in a diversified portfolio, at least historically, no promises, you've really experienced more volatility than you have risk. And to me, there's a tremendous difference in the two. We could spend all day probably talking about that. But I'm curious, you work with people all around the country. Do you see investors maybe confusing that? Am I on an island here? Or have you seen that throughout your career, people not even understanding that because there is a difference?
Yeah, risk is a 4-letter word, so
Right.
we could spend all day.
Right.
And what's interesting is, volatility is a form of risk. So, volatility is just sort of the up and down movement of the market, but it's not the only risk. So I think it's a form of risk, but it's not the only risk. So if I'm an individual, what is my risk? Is my risk that I won't be able to retire? Is the risk that I will run out of money in retirement? Is the risk that I won't have enough saved in my kids' 529 to pay for their college? What is risk? Is risk that I have $10 million and I'm going to go down to 5? So risk can be a very personal thing. It's kind of like we talked about before. Money is very emotional for people. So understanding how they're defining risk is critical to the success of a relationship as an advisor, because you want to make sure that whatever risk means to them, that you're hoping you can't negate it. It's never going to go away, but if you can manage it, if you can mitigate it, that's going to be very valuable to them. But if you're investing in the markets, you're going to see some sort of volatility. You have to take some risk. Even if you have your mattress, your cash in a mattress, you're taking risk. What happens if your house goes on fire? If somebody knows that your cash is in your mattress and they rob your house. I mean, there's a risk inherently in everything we do.
Or if we have inflation.
Exactly. So there's all sorts of risk. It's just a matter of how do you manage it, how do you mitigate it, and it's very personal to each investor of what that means to them.
Gotcha.
So I'm going to get off the topic of the market and ask one of our signature questions. What makes you tick? Now you could take that any way you want.
Yeah, I'd say, from I'll say a work standpoint, which is where I spend a lot of my day, and it actually kind of evolves into my personal life as well. What I've learned about myself is I just really like helping people. Having worked with institutions for a long period of time in my career, you don't necessarily see the impact of what you do as much. But working with advisors, working with high net worth individuals, you can see the impact you're having. You can see the difference that what your advice gives, how you're helping them through a situation, whether it's a down market, whether it's helping them avoid some of these meme stocks and being less emotional about their money, just helping them through life essentially. There's value in it. It's meaningful, and it's something I enjoy doing. So if I'm able to help people with their financial life and have them see success, that's always, a positive thing for me. And sort of what gets us out of bed in the morning is just really, again, being able to help people and see them grow.
Awesome.
Yeah, awesome. Well, thanks for sharing with us. It was helpful for me. I know we talk all the time, and, Eric is one of our partners, and I guess we should maybe take a special disclosure and say Don't construe this as investment advice. This is a discussion. Consult your professional. There's no promises of any future results from any of this. But it's always helpful to kind of go back, talk about these things, our philosophies. And I forget you're my resource on the kids, so we'll talk about that after this show. But yeah, we just thank you again for being here and sharing with our audience. It means a lot.
I appreciate it. Thanks for having me.
Absolutely.
Thank you for joining Connected by Communities, brought to you by Bountown Capital Advisors. Please like us, share us, join us on Facebook, Instagram, and LinkedIn.
Until we see you next time, go out and make our community great.